On behalf of Confederation of Indian Industry and Dhruva Advisors LLP, I welcome all the esteemed speakers and participants in today's post-union budget analysis session. We will have two parts of this session. First, we will have introductory remarks followed by various presentations by the tax expert. And in the second part of the session, that would be very interesting. We will have a panel discussion wherein varied industry experts would share their views over the post-budget analysis. Two quick announcements for the participants before we start. All the participants can post their questions in the chat box with their name, and we will take up these questions post the panel. Also, there would be few poll questions posted in the chat box for the participants. So keep a look over that as well. So I now going forward invite Mr. Vinod Agarwal, Chairman CII Gujarat State Council and Chairman and Managing Director Arunya Organics Private Limited to share his welcome remarks and CII observation on Union Budget 2022-23. I welcome you, Chairman. You can kindly take over. Thank you.
Thank you, Devlina. Distinguished speakers, industry captains, a very warm welcome and good evening to all of you. If had not this pandemic, we would have a physical meeting and a lot more insight can be done. But nevertheless, it is my privilege to share with you a few key observations of Union Budget 2022-23. What at CII we think Budget 2022 has been a landmark budget, progressive and futuristic budget. This year was FM Nirmala Sitharamanji's fourth budget after 2019, 2020 and 2021. Just like last year, this year too, Finance Minister delivered a paperless budget through laptop, which shows that India is moving towards a digitization. It was a symbolic gesture. What we can see that India is moving from a traditional economy to a digitized version of a new economy. Budget 2022-23 had a populist ring to it, interspersed with a string of announcements entailing road, railways, and healthcare projects, etc. This year, Honorable Finance Minister announced more spending on roads, railways, besides its higher subsidies for affordable housing, to name few amongst others. 400 Vande Bharat trains with better efficiency to be developed in next 3 years. Digital University to set up for online with focus on ICT using hub and spoke mode. Startups will be promoted to facilitate Drone Shakti for promotion of drone usage. Also, as mentioned by Finance Minister, budget laid blueprint for from India at 75 to India at 100. We can say the Amrut Kal for India has started. Fund to be set up for finance, agriculture, rural startups under the blended capital risk under co-investment model facilitated through NABARD to finance this kind of startup in agriculture and rural enterprises. Also, an open platform for the national digital health ecosystem will be rolled out. It will consist of digital registries of health providers and health facilities, unique health identity and universal access to health facilities. Emergency credit line guarantee scheme will be extended up to March 2023 and guaranteed cover will be expanded by rupees 50,000 crores to cover an amount almost 5 lakh crores. Also, another 2 lakh crores under CGTSME will be rolled out soon. Production Link Incentive Scheme for achieving Atmanirbhar Bharat has received an excellent response with potential to create 60 lakh new jobs and additional production of 30 lakh crores during the next 5 years. Finance Minister also mentioned the PM's pet project Gati Shakti master plan to make world-class infrastructure. Friends, I am sure these are just a glimpses, and we will, as the evening move forward, we will have more on insight from the experts. Also, I am sure that this analysis session will provide an opportunity to learn and understand the new reforms and challenges which relate to the broader issues of how corporations can govern themselves better going forward. On behalf of CII, we welcome this budget, a progressive budget. You can say it can be an inclusive development with enhanced productivity, energy transition, keeping in mind the climate action. Going forward, let me invite now Mr. Umesh Gala, partner Dhruva Advisors LLP to share his presentation on direct taxes.
Thank you, Vinodji, for your opening remarks. Very good evening to all the co-panelists and co-speakers, and very good evening to all of you friends. Budget 222, with regard to the provisions of the finance bill impacting direct taxes, is what I'm going to cover. This budget was presented in the backdrop of a pandemic. This year, there was significant buoyancy in the direct tax collections. And as is usual, there were a lot of expectations in terms of the wish list of professionals, businesses alike. Let us see what the finance minister has in store for us. Given the time available, I will quickly deal with some of the major provisions which will impact the business community. Is the screen visible to all?
Yes, it is visible.
So first, let me start by, for individuals, there is no change in the tax rate. So the existing slab rates have been maintained. There is a major relaxation in respect of long-term capital gains on assets other than listed securities. There is a surcharge which was applicable depending upon the total income of 25% or 37% on such long-term capital gains. The finance minister has now capped it to 15%, and therefore effectively there is a saving of 2% or 4.5% in respect of tax on such long-term capital gains. For companies, the rates remain unchanged. There are some provisions with regard to bringing parity with regard to cooperative societies. We will not deal with them. Some clarificatory provisions with regard to AOPs, especially in relation to consortium, which are operating for large turnkey projects in India. There is some favorable change with regard to COVID-related expenses. Any amount received by an individual in relation to treatment on account of medical expenses on account of COVID will not be considered to be his income, provided it is actually spent and subject to some conditions which the government is going to prescribe. There is an important beneficial provision with regard to persons who have succumbed to COVID, and in such cases, if the family members of such deceased persons receive any amount from the employer of the deceased, then irrespective of any monetary limit, the amount of receipt will not be treated as income under section 56, and therefore this will not be liable for tax. In respect of any amount received from persons other than the employer, if the amount is received within a period of 12 months from the death of the SSC by the family members, then up to a limit of 10 lakhs, it will not be treated as a taxable income under the provisions of section 56. Let us now deal with some beneficial provision. Government, as part of the Make in India provision, introduced a concessional scheme for manufacturing companies. The concessional scheme, as we all know, prescribed a very favorable rate of 15%. The provision, when it was introduced, required such manufacturing companies to commence manufacturing before 31st of March 2023. We all know that last 2 years we were all impacted by COVID, and there was some disruption in terms of the capex plans of companies. There was a wish by the industry that the time period, the sunset period for completion of the manufacturing facility and commencement of manufacturing activity, which was set at 31st of March 23, be extended by 2 years, since the COVID pandemic almost lasted for 2 years. But the government has heeded to the call of the industry and extended the benefit for one more year, and therefore manufacturing companies who want to avail the benefit of 15% Make in India rate will now need to start commercial production before 31st of March 24. Startups are the flavor of the season. There are existing provisions giving tax deduction or exemption for startups. The end date for eligibility for such startups, which was 31st of March 22, now gets extended by one more year, and it is now 31st of March 23. In respect of IFSC, there are various incentives. Any income arising to a non-resident from transfer of offshore derivative instrument or over-the-counter derivatives entered with an offshore banking unit of an IFSC will not be taxable. Income arising to non-resident from portfolio of securities or financial products or funds managed by a IFSC-based portfolio manager and in an account maintained with offshore banking unit in IFSC will also not be taxable to the extent such income accrues or arises outside India and is not deemed to accrue or arise in India. Angel tax has been a dreaded levy. There is an exemption from angel tax in relation to Cat 1 and Cat 2 AIF, which are regulated under the IFSC Act. Some clarificatory amendments relating to royalty and income from transfer of ship, we will not deal with them. The budget has provided for a new provision for furnishing updated tax returns. We are all aware that government is collecting a lot of data, and basis the data which is being collected, the government is keeping a vigil in terms of whether the assessees are complying with the transactions and offering the correct income basis the various transactions and various activities carried out by the assessee during a financial year. A new provision has been introduced, which is a provision for voluntary compliance. The existing provision provides for filing a return, and if there is an omission or an error in the return, then that return can be revised within the end of the financial year. But in case the assessee discovers any omission, then he is now being provided with an additional facility to file an updated return within a period of 2 years. In the updated return, the assessee will have to pay tax on any additional income. If the additional income which is offered is within a period of 1 year from the end of assessment year, then the tax liability which the assessee will be required to discharge will be in addition to the tax, the surcharge and the cess, and any interest under the provisions of the Income Tax Act. On the total quantum, an additional 25% will need to be payable by the assessee. But if the revision is done after 1 year and before the end of 2 years, then this 25% gets doubled and a total of 50% becomes payable. Updated return can also be filed in a situation where the assessee has not filed the original return. And there are various provisions which have clarified that in certain situations, the assessee will not be able to file an updated return. Some of those things where a notice for assessment or reassessment is already issued, if there is a FEMA violation or a violation under Benami provisions, there are various provisions which assessee cannot take the benefit of reduction of the original tax. Assessee will not be entitled to claim or file a loss return by virtue of the updated return. Cryptocurrency, NFTs and virtual digital assets are again one other flavor of the season. There is a lot of discussion on crypto assets, and a large number of Indian assessees have invested in crypto assets. There was an expectation which has materialized that the government has introduced a taxation framework for crypto assets. The definition of a virtual digital asset has now been provided in the law. and it is treated as a property for even the deemed gift transaction under Section 56. Any income from the transfer of virtual digital asset will be taxable at 30% plus applicable surcharge. No deduction or allowance other than the cost of acquisition will be allowable. This income from virtual digital asset will be a separate block of income, and therefore any loss or other deduction which the assessee may have by virtue of his existing business or activity will not be allowed to be set off against the income from virtual digital asset. And there is also a provision for TDS of 1% on any payment made to a resident towards either the purchase or the transfer of the virtual digital asset. And obviously, this TDS will now need to be deducted by the platforms which enable such assessees to purchase or transfer the virtual digital asset. Let us now look at some major provisions which impact business expenditure. There is an existing provision which seeks to disallow any deduction which is an offense under any law. And there is a particular set of provision which is now introduced. It's a clarificatory provision, but which will largely impact a lot of pharma companies. Most of the pharma companies who operate in the regulated markets pursue various litigation on account of either patent laws, and if there is any payment on account of any offense, the existing provisions didn't clarify whether the offense was only restricted to an offense under an Indian law. Now there is a clarificatory amendment to say that the offense which is prohibited under any foreign law will also be covered. Similarly, if there is a patent law settlement or any other similar settlement pursuant to which there is a compounding of the offense and the assessee makes the payment on account of such compounding of an offense, even if that offense is under a foreign law, then it will be hit by the explanation to Section 37 and therefore not allowable as business deduction. But the most important amendment which will impact a large number of pharma companies is with regard to what is popularly known as doctors' freebies. Pharma companies incur a lot of promotion, sponsorship, continuing medical education activities for doctors. And the obvious purpose of such sponsorship, whether it is foreign trips or educational seminar, is to get favorable sponsorship, favorable recognition from doctors who prescribe medicines for the patients. The medical council regulations are applicable to doctors. Those medical council regulations were amended to provide that doctors are prohibited from accepting any such benefits accorded by the pharmaceutical companies. And therefore, the CBDT issued a circular to say that any payment on account of such doctors' freebies will not be deductible for the pharma companies. However, pharma companies took a stand that the restriction is under the medical council regulations. Such restriction is only on the doctors and it does not impact valid business promotion expenses incurred by the pharma companies. The government has now come out with a provision which is a clarificatory provision to say that the intention of the law was always that such expenses or such payments received by a person who is prohibited from receiving such benefits will be treated as an offense or a prohibited activity under the law and therefore not be allowable as a deduction. There would be some controversy in terms of, because of the nature of the provision, whether it is retrospective. I think the intention of the government is to make it retrospective. Assessees will need to undertake a fight to possibly argue that the provision is only prospective and only time will settle how the courts finally take a view. The budget has a lot of provisions which seek to undo benefits which have been granted by various court decisions. And let us now deal with one provision which is concerning education cess. Income tax, in addition to the tax, there is a surcharge and there is a education cess. Under the existing provisions, tax is not a deductible expenditure. There was some controversy on whether education cess, because of a specific nature of the education cess, whether it partakes the character of tax. There was a circular of the CBDT of 1967, which clarified in relation to the position at that point in time that a cess is not in the nature of tax. And the SSCs took benefit of this circular and put in claim that whatever is the payment on account of education cess because of the CBDT circular and the nature of the education cess going into a separate fund is not in the nature of a tax and therefore not hit by the existing restriction on allowance of the tax, and therefore there were a string of decisions in favor of the SSC, starting with Rajasthan High Court, Bombay High Court, and multiple tribunal decisions. Now all of those decisions have been undone. The government has introduced a provision with effect from 1st April 2005, and again this is also a provision which is clarificatory. So we have one set of clarificatory amendment which is prospective, and we have now another set of clarificatory amendment which is retrospective, and therefore there is going to be a seesaw in terms of whether a clarificatory amendment from an earlier date will be treated as retrospective, but a clarificatory amendment from a prospective date, whether it will be retrospective or prospective. And this will impact a large number of assessees who have pursued such claim. And if the provision is held to be retrospective in nature, there will be questions in terms of penalty. Possibly no penalty may apply, but certainly there could be issues in terms of whether interest will need to be payable. A major provision with regard to foreign dividends. Any Indian company pursuing overseas investments, if it receives any foreign dividend, those foreign dividend was taxable at a concessional rate of 15%. Now, the provision by virtue of section 115 BBT has been deleted, and therefore any dividend received from a foreign subsidiary with a minimum 26% equity holding will be treated as a normal taxable income. Of course, if the recipient company pays this foreign dividend by virtue of a onward distribution to its shareholder, then they would be entitled to claim benefit of deduction under ATM subject to the conditions of section ATM. Again, government seeks to bring parity in terms of dividend received from domestic companies, and therefore this provision has been introduced. There is an important set of amendments with regard to succession and business reorganization. There are Supreme Court decision in the case of Maruti Suzuki, which has held that any assessment or reassessment in respect of a predecessor entity after there is a merger or demerger order of the applicable code, then such proceedings which are pursued in the name of the predecessor entity, they are not valid, and therefore any assessment framed on the predecessor entity is treated as non-est and no tax liability will arise. The government again has made a clarificatory amendment, this time with effect from 1st April 22, to clarify that even if the assessment is made in the name of the predecessor entity, it will be treated as if it is an assessment in the name of successor entity, and therefore the benefit of the Supreme Court decisions will not be entitled to the SSC. What is very common in such business reorganizations is that the business reorganizations are pursued with an effective date and an appointed date. We have a Supreme Court decision which says that for tax purposes, it is the appointed date which is relevant for consolidation of all the income of a company either under a merger or a demerger. There is a good provision which has now been introduced, which recognizes that pursuant to such order under a business reorganization, the amalgamated company or the resulting company will be entitled to file a revised claim consolidating the activities of the amalgamating company or the demerged company. And this return will need to be filed within a period of 6 months from the date of NCLT order. Let us now deal with some provisions with regard to curbing of tax avoidance. Bonus and dividend stripping is very common. There are existing provisions with regard to bonus stripping which were applicable for units of a mutual fund. Now it has been clarified that bonus and dividend stripping provisions will be applicable not only to units of a mutual fund, to even equity shares, to any units of a REIT or an InvIT, and this will also cover investments in AIF units. A major provision which deals with cash credits or any undisclosed income. If you see a string of amendments, the government possibly is trying to curb any tax avoidance or they're trying to plug loopholes. So with regard to any loan or borrowing, there were favorable decisions that the onus of the SSE is only to prove the nature of and the source of the funds from where the SSE has received. With regard to share application or issue of shares, there was a provision which extended that you not only have to establish the source of your receipt, but even the source of the person who has invested in your shares, that also needs to be discharged. So the onus now is also in respect of any loan or borrowing or any other sum, where the SSE is now required to not only explain from where the loan or borrowing or such other sum has been received, but even establish the source of the funds of such person who has given the loan or borrowing. There is also another provision which says that if any income in the nature of such loan or borrowing, which is treated as a cash credit, is treated as an income, then existing losses or business losses or unabsorbed depreciation will not be set off, and therefore on the gross amount the SSE will be liable to pay tax. There are significant changes with regard to reassessment provisions. Last year in the last budget, the entire framework for reassessment was a new framework was provided, and when the new framework was introduced, there were some controversies and some gaps which have now been set right. The first is that under the existing reassessment provision, when the AO seeks to invoke any reassessment, he has to give a show cause notice to the SSE. SSE can give a reply, and pursuant to the reply, he has to pass a speaking order. There is a clarificatory amendment to say that once an SSE passes a speaking order, then he does not have to seek a prior approval for pursuing with the reassessment if he believes that the reassessment is permissible under the law. Under the existing provisions which were introduced last year, all reassessment is now based on information. The information as was defined under the existing law has now been expanded to cover information will now include any audit objection, not just restricted to a CAG audit objection, any exchange of information under tax treaties, any information pursuant to scheme for faceless collection of information which the government is trying to digitally monitor information, and any information pursuant to any tribunal or court, and any impact that needs to be given pursuant to such tribunal or court decision. The reassessment period for reassessment, we have two windows, one up to 3 years, and there is an extended period up to 10 years. The extended period up to 10 years covers any asset which has been discovered by the assessing officer in excess of 50 lakh. Now that asset is widened to cover even an expenditure in relation to any transaction, event, or occasion. So if the assessee has incurred marriage expenses for any of the family members, and the expenses would have been incurred 5 years ago, and if there is information in the possession of the tax officer, then he will be able to reassess for a period up to 10 years. This also now covers entries in books of accounts or even diaries. There is a small change with regard to withholding tax for international payments. Under the existing regulations, if the Indian payer is supposed to make a payment to a non-resident, and such payments are on a gross-up basis, meaning that the tax or the withholding tax on such payment needs to be borne by the assessee who is making the payment, then in such cases, the assessee could have contested that having deducted the tax, if the assessee is of the view that the tax was not required to be deducted either under the domestic law or under the treaty law, then he could have filed an appeal before the CIT appeal. Now, that window has been closed, but the assessee now gets the benefit of filing an application before the assessing officer. The assessing officer will be required to consider the claim of the assessee, pass an order, and the order is to be passed within a 6-month time period. And if the order is against the assessee, then the assessee can pursue an appeal. Let us now deal with some provisions relating to tax compliance and dispute resolution. So the government has introduced faceless assessment scheme, faceless appeal scheme. Now under the faceless assessment scheme, there have been a flurry of court decisions which have held that because of some technical violations, if the assessing officer or the NFAC, as it is called, did not pursue the appropriate procedure, and there were some technical gaps in pursuing the procedure, then the assessment will be treated as non-S. And there was a provision in law which had codified this. That provision has now been deleted. There is again a favorable provision to ensure that the ease of doing business is extended. So if there is an issue of law and the department would generally pursue an appeal in case of such issues of law. Now, if the department feels that there is already an existing High Court or a Supreme Court pending matter which deals with the same question of law, it need not be in the case of the same assessee, it could be any other assessee. But if the question of law is identical, then subject to a particular procedure, there is a collegium which will be formed. The assessing officer can make an application to the collegium subject to the assessee confirming that the issue of law is common. The department will not file any appeal. And as and when the pending matter in any other Supreme Court or High Court is settled, then the department will be able to pursue, and therefore this will possibly reduce the litigation on account of common issues of law. I will deal with some important provision with regard to section 14A. 14A, as we all know, is restricting any expenditure or allowance incurred by the assessee in relation to any exempt income. There have been court decisions which have said that this disallowance of expenditure is restricted on, or is applicable only in situation where the assessee has received any exempt income. Now the government has clarified that even if there is no exempt income which is received, so I have made an investment in a company under the law, previous law where the dividend income was exempt, and I did not receive any dividend income from such company, but if I have incurred any expenditure in relation to the dividend income, those expenses by virtue of the various decisions were not disallowable under section 14A. but the government now seeks to clarify that the intention was always that such expenses would be disallowable. Again, it will add to the controversy on whether such clarificatory amendment will be held to be retrospective or only prospective. Another Supreme Court decision in the case of Aqua with regard to 43B, which says that any interest is deductible only on actual payment pursuant to IBC and various other restructurings carried out by banks. If such outstanding interest is converted into a debenture, the Supreme Court held that such conversion of outstanding interest into a debenture will be treated as payment of the interest and therefore not hit by 43B. Government has now clarified that again the intention was always that only on an actual payment of interest it will be treated as deductible under 43B, and therefore the same set of controversy will continue. The timeline for notification of faceless assessment scheme for transfer pricing assessments and DRP is now extended from 31st of March 22 to 31st of March 24. There are some other provisions. I think on account of paucity of time, we will not cover these provisions. And if there are any other provisions which any of the participants need some clarification, maybe during the question answer session, we will deal with those questions. In the last budget, there were some TDS provisions which were introduced in respect of any recipients who are not filing tax return. Those provisions were introduced earlier for a period of where the recipient had not filed the return for a period of 2 years. That period of 2 years is now reduced to 1 year. There is an exclusion which is now provided for TDS provisions pertaining to transfer of immovable property, payment of rent to individuals or HUF, and payment of certain sums by an individual or an HUF. There are some other procedural changes with regard to TDS. So transfer of a virtual digital asset will be liable for TDS at 1% with an effective date of July 1, 2022. Lot of companies which are incurring any expenditure by virtue of taking their agents or dealers on foreign tours or providing any benefit to such agents or dealers, and in the process they incur an expenditure which is treated as a benefit or perquisite in the hands of the recipient agents, who are of course carrying on their own business activity. There is now a provision which says that before incurring such expenses, there is a TDS of 1%. So if the benefit is provided in cash, then the TDS will be applicable at 1% on the cash payment. If the benefit is provided in kind, even then the TDS at 1% will be applicable. With regard to any payment for purchase of immovable property, there is an existing provision for TDS at 1%. That 1% will either be on the consideration under the agreement, and if the stamp duty ready reckoner value of the consideration is higher than the consideration under the agreement, then this 1% will also be applicable on the stamp duty value, and therefore whichever is higher, on that higher value, the TDS of 1% will need to be done by the SSE who makes the payment for purchase or acquisition of such immovable property. There are a few other provisions with regard to TDS. I think we will not deal with them. There are a string of amendment with regard to charitable trust. The scope for cancellation of registration has now been expanded. The order for cancellation is to be passed within a period of 6 months from the end of the quarter in which the inquiry is initiated. If the charitable institution is passing on any unreasonable benefit, meaning a benefit for user of any asset of the charitable institution to the trustees or any relatives of the trustees, which is lower than the arm's length price, then there is a penalty in the range of 100 to 200% for the benefit. The framework for charitable trust covers certain institutions which are entitled to benefit of exemption under 1023C. So there are existing provisions for some exit tax which were applicable to charitable institutions which are covered by section 11 to 13. Now those provisions are extended to institutions which enjoy benefit under 1023C as well.
Sorry to interrupt, sir, but we can move on for the next presentation.
Yeah.
Panel lined up, please. Thank you.
Yeah. So, friends, thank you for the opportunity given to me to deal with the provisions relating to direct tax under the budget. And as discussed earlier, if there are any questions, happy to consider during the question answer session.
Thank you, Mr. Umesh, for an in-depth insight on the direct taxes. I was going through the finance bill, the attachments. It shows that the work of chartered accountant will increase in coming days. Thank you once again. And may I now request Mr. Neeraj Bagri, partner Dhruva Advisors LLP, to share his presentation on indirect taxes.
Thank you. Thank you, Mr. Vinod. And good evening to all the co-panelists and friends in the audience. For indirect tax proposals, the budget, has lost steam what it was earlier with the introduction of GST. And that's the, idea that we live with. But unfortunately, once you go through the fine print, as someone mentioned that the time allotted by the finance minister to talk on GST was 3 minutes. But if we have a look at the provisions which have been introduced, and you realize the provisions are going to have far-reaching impact, to all the SSCs. Is my screen visible, Devalina?
Yes, sir.
Yeah. So once GST was introduced, the entire idea was that the system of filing return and taking the credit should be automated. So whatever the suppliers declare as their output supplies, the recipient should get the credit based on that. So this was the idea at the time of launch of GST on 1st July 2017. But the humongous task which involved in getting the IT system up and running, it was quite clear that it is not possible in the short time frame, and therefore the government sort of discontinued that process and introduced a simpler return of 3B. And then gradually in the last 5-year period, we have seen that they have step by step taken measures to introduce automation in the entire process of reporting your outward supplies. And now we are talking about how you're going to take the input tax credit. So we have seen the introduction of e-way bill, then e-invoicing provisions, which would have taken care of all the declaration of the outward supplies. And recently some amendments were made by introducing an Annexure 2B. Before Annexure 2B, this entire debate on the credit should have been taken basis the invoices declared by supplier, which comes in the form of 2A, and a lot of notices already being issued by the department saying that there is a mismatch between what is appearing in 2A and what is declared by the SSC in GSTR 3B. And the problem with 2A was it was not a static document. So anytime you download the document, it may throw up a new, give new details of the invoices. So recognizing that difficulty, now Annexure 2B, which has been introduced from 1st January 2022, is a document which will be available to the recipient, which will give the details of, the supplies declared by the supplier. And the idea is the input tax credit should be taken based on that document. So this was the provision or the facility which got introduced a month back. Now we see a stream of changes being made in the legislation to give sanctity to this entire process. So firstly, what has been done is that the entire concept of matching and mismatching, which was there under the earlier provisions of 37, 38, 39 and 42, 43, they have been deleted. And it has been replaced by a new mechanism by amending section 38, saying that the recipient can take the credit based on the annexure to be which is generated and given by the system. So that seems pretty simple, but the challenge is that any company which is recording its purchases and so far recording the input tax credit based on the purchases that has been counted in the IT system. Now we'll have to also see that what are the supplies that are declared by the supplier which is appearing in 2B. And so far as filing of return is concerned, annexure 2B will be the sacrosanct document basis which the credit can be taken. And this has been made as an additional condition to section 16. So section 16, as all we know, provides the conditions basis which the input tax credit can be taken. So there is a new condition which has been inserted saying that it should be as per the annexure 2B. Again, annexure 2B will detail on the invoices on which credit can be taken, as well as invoices where the credit are limited or cannot be taken. Now, what are those limitations which has been prescribed under the law? So, often we have seen that someone has taken a GST registration and probably there is a fraudulent intent and the returns are not filed or the taxes are not paid. So the government may prescribe a time limit for all those suppliers which have taken the registration, the duration up to which the recipient cannot take the credit. So for example, if I've taken a registration today, maybe 1 month, 2 months, 3 months time, whatever time limit the government feels is appropriate, can be prescribed, within which all the supplies made by these newly registered person, the input tax credit cannot be taken. Some other conditions are that if somebody has defaulted in payment of tax, or let's say someone has actually declared the supply in the GSTR 1 while filing of 11th of the next month, but when discharging the taxes in GSTR 3B, they have short paid the tax. So this was a classic question which has been sort of troubling the SSE as to how do I ensure that whatever supplies that has been declared by the supplier, the taxes has been paid. Because the department has got a tendency to sort of, give and go after the recipient to say that the supplier has not paid the tax. Therefore, whatever input tax credit that you have taken, you need to reverse that. Now, frankly speaking, the recipient does not have any control over what the supplier does and, whether he has paid the tax on time or not. So this statement will also probably, give the details of those supplies which has been declared by the supplier, but taxes have not been paid, and therefore the recipient will not be able to take the input tax credit. Then if some supplier has taken excess credit, again, this is something which the department probably will do some audit of that supplier and, maybe consider him as someone who has used excess credit and therefore his invoices may be disentitled to the credit. So a lot of these conditions have been, provided in the statute. To say that the annexure 2B, which will be made available through the IT system, will give you the details of the invoices on which the input tax credit can be taken. And therefore, now companies will have to adopt a modus operandi where they will have to, kind of reconcile this statement with their input tax credit register to understand, what all credits have been taken, what all credits have not been taken, to be taken in future, etc. So this, while from a government standpoint, they are looking to, make the input tax credit available only if the taxes are paid. But a lot of, effort will be required to be done at the SSC level to identify such credits, or rather keep track of such credits to ensure that it is taken, at an appropriate time. And having introduced a conditionality, again, under section 16, this will have a ramification that one cannot really claim which is, specified beyond what is covered in annexure 2B. So another amendment, which is a welcome one, is to extend the time limit for taking credit. So, so far the law had provided that, the due date for filing of the return for the month of September, which effectively mean 20th of October, would be the date up to which the credits can be taken for the past year. Also, if any debit or credit notes are required to be issued, that was the deadline for issuing those credit note and debit note. Now that time limit has been extended till 30th November. Now 30th November really is the date, but practically speaking, it will be 20th November, because if I issue any credit note or debit note or take any credit beyond 20th November, then it will get reflected in the return which is to be filed for the month of November, which will be 20th December. So practically, the date will get extended to 20th November, unless of course, one takes a stand to file a delayed return until 20th, which will have an interest implication. Again, as I mentioned, the provisions relating to matching of credit are now omitted, and therefore a question which comes to mind as to what will happen to those old notices which have been issued by the department stating that the credits do not reconcile with 2A, whether they will stand the scrutiny before the court, because if the provisions itself have been amended and omitted, maybe the courts will take a favorable view of this entire matter to say that ultimately if the credits have been taken are justified, so that reconciliation is not something that is warranted. Some substantive provisions have been introduced so far as filing of return. This is to ensure that the supplier does not have a gap in filing of the return. So if, let's say, the company has not filed the return for the month of January, then they will not have the option of filing the return for the month of February. Basically, the returns need to be sequentially filed. And if GSTR 1 is not filed, then GSTR 3B also cannot be filed. So it is sum and substance of these changes are that all the returns have to be filed. This is tying with the entire philosophy of ensuring that all the supplies are reported by the supplier, which will become the basis for the recipient to take the credit. Again, changes made to section 41, which basically said that any credit which is taken by the company is provisional. Now the concept of provisionality has sort of been done away with, and saying that it is on self-assessment basis, because now the company will be taking credit based on annexure 2B. The provision of if the supplier has not paid the tax and the company has still taken the credit, then there were provisions under earlier section 42 which is now omitted, has now been brought in within section 41 to say that if the supplier has not paid, the recipient is required to reverse, but once the supplier pays, then the recipient can take the credit. Another welcome change is in section 50, where the subsection 3 has been reworded, and now it provides that if any input tax credit had been wrongly availed and utilized, then only the interest will be payable. So effectively, mere wrong availment would not lead to an interest liability, so long as it can be demonstrated that that wrong availment was not utilized and reversed before being utilized. There is one one amendment which has been made, and we yet don't know the sort of impact it can have, is the introduction of subsection 12 to section 49. Now, what does it provide? It provides that the government can prescribe situations, criteria, sector, etc., where they can limit the usage of input tax credit for paying the output tax liability. Now, we already have one provision in Rule 86B, where in certain situations, a company or the assessee is required to pay certain amount of output tax liability in cash, even if it has got an input tax credit balance. Now, the introduction of this section hopefully is probably to sort of sanctify that rule. But if one sort of goes further and see, if you recollect, we had similar provisions under the old service tax law before the integration happened with the excise law, where the service tax law provided that 20% of the output tax liability has to be paid in cash. So therefore, even if you have a higher input tax credit balance, that could not be utilized to pay the output tax liability. Now, only time will tell to what extent these provisions can be used by the government to limit the use of input tax credit for paying the output tax liability. If it comes out with provisions which were there under the old service tax law, then it could mean a higher cash outflow and working capital requirement for the industry. And of course, sectors where there is already an inverted duty structure and where there is accumulation of input tax credit happening, then again, it will just going to worsen the situation for those sectors. The other set of changes is, allowing transfer of cash, which is there in the electronic cash ledger of an SSC. So if it is a transfer is happening within the same state, then, it is fungible. One can take it from integrated tax, central tax, or state tax. But if it is, if the transfer is going to be done between two different states, and then it is permissible only with a distinct person. So basically the registration of the same company in another state, and it can be done only between integrated tax and central tax. There is a proviso and there is a catch to say that if there is any unpaid liability in that state where you're having a cash balance, then you cannot make that transfer. Then again, some provisions have been made, clarifying what is the relevant date for filing refund claim for SEZ law. I mean, this was the position which has been followed, now sort of sanctified within the statute itself. Again, retrospective amendment to provide the rate of interest should be 18% under section 50. Again, this retrospectivity will be from 1st of July 2017. These were the key changes which was there under the GST law. We can just go to the changes which have been made under the customs law. So we had a decision by the Supreme Court in case of Canon India, where the Supreme Court came to a conclusion that an officer of a revenue intelligence or an audit department is not notified as an officer of customs. So therefore, any notice issued by such entities is not a validly issued notice under the law, and therefore the Supreme Court had dropped the demand in that particular case. Following the decision of the Supreme Court, there have been plethora of decisions of the High Court accepting the proposition and dropping the demand wherever the notices have been issued by the DRI. As anticipated, the budget has made amendments to the customs law, enabling even the officers under the DRI and audit formation to be officer of customs. Again, this amendment has also been made retrospective to ensure that it can overcome the decision of the Supreme Court, and therefore only time can tell whether anything which has been held invalid can be rectified with a retrospective manner and make something which was not considered within the four corners of law to be within the four corners of law. We have some changes to the advance ruling provisions, basically allowing withdrawal of the advance ruling application before the hearing is done, a ruling is pronounced. So earlier the time limit of 30 days was there. Now it says that it can be withdrawn anytime before a ruling is withdrawn. One change which honestly I did not have an answer is that validity of the ruling has now been restricted to 3 years. And in fact, if there is a change in law, in fact, then it can be withdrawn even earlier. Now, advance ruling is something when somebody is looking for a tax certainty, and if the ruling itself is held valid only for 3 years, then it may further make the scheme unattractive. As it is today, if we see there is a lot of pendency, and it takes a considerable amount of time for the application to be disposed. And if that ruling itself is now held valid only for 3 years, maybe the companies may not find the scheme at all to be attractive and for companies to go for an advance ruling. There's another very important change which has been highlighted in the budget, and of course we'll have to wait and see. The SEZ laws are going to be revamped, and it is going to be replaced with a new law, and we'll have to see what are those changes and what are those criterias which are going to be be undergoing a change in the new law. The last one is an important change being made to give impetus to Make in India, where wherever finished goods are being imported, capital goods for textile, power, petroleum sector, it enjoyed an exemption from basic customs duty Even otherwise, there was a project import scheme which enabled the import at 0% or a lower rate. The government is intending to withdraw the exemption or charge a concessional rate of 7.5% for these finished goods. And also several raw materials which are imported have now been given the benefit of concessional rate of duty in order to encourage more manufacturing and production in India, which seems to be the step in the right direction. So these are the key changes which are there in the indirect tax sphere. Happy to take any questions in the question answer session. Thank you.
Thank you, Mr. Bagri. Now moving ahead, I think we got a good insight about the direct and indirect taxes. Without wasting time, let's move on the interesting panel discussion. And I hand over to Mr. Umesh. You will handle the panel discussion.
Thank you, Chairman,
Over to
and
you, Mr.
thank you
Umesh.
to all the experts in the first session. Before moving ahead with the panel discussion, I would just like to quickly introduce the moderator and the panelists in brief. So we have moderator Mr. Umesh Gala, partner with Dhruva Advisors LLP. From the panelists, we would have Mr. Komal Anand, Managing Director, Have More Ice Cream Private Limited. We would have Mr. Pawan Bakeri, Managing Director, Bakeri Group. Professor Jyoti Chandiramani, Director, Symbiosis School of Economics and Dean, Faculty of Humanities and Social Sciences. We would have Mr. Nupesh Shah, Executive Director, Symphony Limited. Mr. Samrat Ghatak, Assistant Vice President with Corporate Affairs, Cadila Pharmaceuticals Limited. Mr. Hiranand Savlani, Chief Financial Officer, Astral Limited. I welcome you all in this panel discussion today. And we will take up the Q&A post the panel discussion. I request Mr. Umesh Gala to kindly take over the session ahead. Thank you.
Very good evening to all our panelists. We have a very distinguished set of panelists, and without much ado, I will shoot off my questions. My first question is to Professor Chandiramani. Ma'am, what is your take on the budget, your first impressions on the budget, and how does it, what does it do to the economy, the growth, etc.?
Yeah. Good evening, everybody. Nice to talk to all of you from Pune, or Pune as we call it. It looked like a very long-term vision statement. They talked about from Amrut Mahotsav to the 100 years of the Indian economy, and therefore it looked like a long-term budget that came in. The tax buoyancy, because of the growth that has revived, was very much evident, which we could see in the economic survey also and other documents that we've been studying over the last few days. But what is definitely on our mind has been that the tax GDP ratio has not moved up. And this, for me as an economist, this is of grave concern, because your focus is always on direct and indirect taxes, but we look at it more from a macroeconomic perspective. So looking over there, we can see that the tax buoyancy has got reflected because of the GDP numbers, which look better. Again, when it looks better, it only looks better because we have gone back to pre-COVID days. But really speaking, before that also there was a slowdown. So actually speaking, that big push has not come up. Now let us see what comes out of this budget. The big push has been given with respect to infrastructure, but this is only the time that can tell. And when we talk about the infrastructure push that has come in, we can actually see even the World Bank data, which says that India is going to be one of the top growing economies when you compare it with US, with China, with the top populated countries, be it Brazil, be it Mexico, Nigeria. So definitely India is there in the emerging economies and is going to see a high growth. So the high growth is going to give you high tax revenues, and you could see that the tax rates have not really been touched. So you're going to get additional fiscal space. The additional fiscal space that's going to realize, we have not seen the document so thoroughly, but I'm happy to see that health has had a 1% increase, which is frugal, but education has had a 18% increase in expenditure, which is which is monumental and I think in the good direction. But moving from there, I think the Gati Shakti super infrastructure budget that I call it, has been a aspect in very good direction, because in the logistics index, India ranks around 44, 43 in the ranking. And if we can come in under 30, that would be good, because you could see even if the logistic industry does well, then the exports also become good. Again, the last 10 months, I've seen exports doing excellently. But when you see the exports, they seem to be gems and jewelry. They seem to be petroleum refined goods, which are going out and coming back from US, UAE, and, the West Asia as our partners. So that's something I was a little disappointed in seeing what we were exporting. So the export basket definitely needed sectoral pushes. See, as an economist, when we look at the budget, it has an allocative effect, it has a distribution effect, and it has a stabilization effect. Now, the allocation effect, it was very different compared to the budget speeches that we have seen in the good old days, where, allocations are talked about from schemes, etc. Here now, it is left to us to figure that out. So it's going to take a little time in detailing. But one of the aspects I'm disappointed in is the allocation to employment. And the NAREGA scheme, if you look at it at the minimum wages that is to be given, it should have been beyond 2 lakh crores. But for a 39 lakh crore budget, to put aside 2 lakh crore for employment should have been the space that would have been allocated. I think that would have been done well to them, from looking at the inequalities, from looking at it even as an election year. But I think they have refrained from that. Last year's budget talked about a lot of specific emoluments going to specific states because of the elections. But this time they have refrained from that. So I do appreciate that aspect, definitely. But coming back, I do feel that, the Gati Shakti infrastructure budget, which looks at roads, railways, airports, ports, is a direction, is a movement in the right direction. Even last year, if you remember, there was a lot of push on transport with metro. So here I feel that you have tier 2, tier 3 cities, and they have talked about it in the aspect on urban planning, on transit-oriented development. So there have been the right noises which should be able to fuel growth and help India move to becoming what is called, take our per capita income to double and help us merge into the higher middle income category. But this is something that would get realized maybe from 2022 to 2030. So moving to the $5 trillion economy should happen. But again, there are two other issues over here, which I think they tried to address it. That is the amount of investment absorption capacity that the economy has. And that would depend upon it from the expense, from the land point of view. And you can see digitization of land, etc. The digital aspect was very oftenly used term in this entire talk. So labor decoding was not done. So definitely, while productivity will increase, you will find a substitutability between labor and capital. And therefore, employment may. So we have to be very wary of what we call jobless growth. But I am more worried about the other aspect, which is the job loss growth that may come in. I think that is what I am really concerned. The capital expenditure has been allocated well. And again, as I said, it depends upon the absorption capacity. What has been kept aside has been the disinvestments. And I think it's good it has not been discussed because it has been a failure over the past. So it's best to keep it outside the budget and as and when it happens. But it's a time, I think it's an opportunity lost for the government to not have disinvested in the last financial, because the capital markets were very, very good. So this is a mixed bag, but what I really am concerned about are three aspects. One is the inflation is going to play the spoil sport. You're going to import inflation for sure. The second point is, I think unemployment is very high. Recently, there was the Bihar riots, or you could hear about it, where for 2,400 odd jobs, there was more than 22 lakh applications over there. So I think that was a Narega. What was assigned to Narega was very limited and has been much lower than what it was, what should have been there. Though unemployment from April and May 2020 has come down, but the job creation may be on the avel, but is it really going to get realized? So here I feel the government has failed to create the jobs that it should have in its own sector. You know, tier 2, tier 3 cities need governance systems. So I think that is where it should have come. It would have done good to the sentiments of the people, of the young graduates. And another aspect is the inequalities that are there as per the Oxfam report. We'll have to see where the money goes really, and will it reduce it? Yes, I can see electricity for all has come in. Water also has been given a very big push this time again. So you talk about the bare necessities index, and that has been addressed over the last few budgets. So it's just there. So I think I'll stop here. By and large, I call it more of a vision statement than a budget, because it didn't speak clearly about the distribution and the stabilization effect. The allocation has been done. Thank you.
Thank you, ma'am. I'm sure you have a lot to say, but we have other panelists, and there are follow-up questions, and I'll come back to you pretty soon. We have Mr. Samprak Katak from the pharmaceutical industry. Last 2 years, pharma sector has been in focus. India is moving to become the pharmacy for the world. So, Mr. Ghatak, what is your take in terms of the budget, and what does it have in store for the pharma sector, both domestic as well as export? Any quick takes?
First of all, thank you for this question, and I think and probably, you know, identifying the healthcare and the pharma sector as over the other sectors to discuss first. You know, as you rightly said that, you know, over the last 2 years, it was critical for the public and the private entities across the pharma and the healthcare value chain to collectively work towards, you know, for making the sectors future ready, and the union budget is actually for the first step towards that direction maybe. But I do agree with Professor Jyoti ma'am that, you know, it is more towards, it looks more towards as a vision statement for the upcoming decades to come, rather than, you know, the solutions which we need to address probably today. Although in her speech, Honorable Finance Minister identified genomics and the pharmaceuticals to be among the, you know, sunrise opportunities eligible for supportive policies with light touch regulations, facilitative actions for building up the domestic capacities and promoting R&D. But I think you know, if certain activities like the production link incentive schemes, and the review of production link incentive schemes for the pharmaceutical sector, and the increased of the budgetary allocation for the healthcare segment as a whole, you know, if those would have been actually addressed, it would have been wonderful. Just to give you a kind of a you know, idea that an increase in the public spend in healthcare from 2.5% to 3% of GDP was already envisaged in the National Health Policy in 2017. And a budgetary allocation for R&D in the biopharmaceutical sector would have been really crucial in that segment. Although the minister talked about the promotion of R&D in pharma with an ease of doing business, I think, you know, a little bit more clarity of how this would be actually envisaged for the domestic market as well as for the exports would have given more clarity as well as direction towards that, how this particular segment and the industry would move forward for this next year. So I'll stop here as my initial comments. But what I see, we can always discuss a little bit more once we go along. But these were the first insights, what we heard in terms of pharma and healthcare sector from Honorable Minister.
Thank you, Mr. Ghatak. We have Mr. Savlani, who represents the broader manufacturing sector with a pulse on the real estate as well. So, Mr. Savlani, your initial take in terms of what does this budget do for manufacturing sector, whether the private capex investment will match what the government expectations are. Your thoughts on what this budget does for the manufacturing sector, sir?
So I think it's a long-term visionary budget. It's created a trust building exercise because of the transparency of the data. And it's a strong pillar for the Atmanirbhar Bharat and push to the digitalization. And the best part of this budget was nothing was a surprise element into this budget. There was no negative part in this budget. So I think that was the best thing in this budget. Fiscal deficit target of 6.4 is welcome step, though street expectation was 6.2. Again, that it is little higher. But we have to also see the quality of the fiscal deficit, because out of this fiscal deficit, if you see 7.5 lakhs crore being allocated to the capex. Now, if you add to in this figure, the grant to the state, then it work out to be 10.68 crore allocation to the capex, which is working out to be 4.1% of the fiscal deficit of GDP. Okay, so if that is the allocation to the capex side, I'm sure that is going to help in a big way to the industry, because ultimately it is going to spend, and that is going to create manufacturing side support, and at the same time for the job creation also. So overall, I think this was a good move, because you see the other countries also in this difficult time. I think fiscal deficit should not be a worried figure for the country. I think it is a booster dose for the pandemic hit economy, and I welcome this step. And secondly, this PLI scheme. I think PLI scheme has worked very well, and I think in the speech also, Honorable Finance Minister had given a thrust on that. The 14 different scheme has given a good support, and the kind of number they are talking, that they are going to create a 30 lakhs crore rupees of production, which is a huge number in the next 5 years, and it is going to create a 6 million jobs. That is also a very good number. So overall, if we see this all, I think I am very satisfied with the budget. Little bit disappointment was there from the budget that to the real estate side, ATIAB extension was not being given, because builder community, I think the developer community is suffering because of this COVID, because of lockdown. The construction activity got slowed down. So because of that, many of the projects were not able to be completed. So if that extension could have been given 1 year more, that could be a good booster dose to the construction industry. And we all know that Indian construction industry is not only one industry, but it consists of more than 250 different categories of product. So if that could have been extended, that could have been a welcome step. But otherwise, overall, I think it was a good budget.
Thank you, Mr. Savlani. We have Mr. Pawan Bakeri, and my next question is to Mr. Pawan Bakeri, who has interest both on the real estate and also on the startup sector. So, sir, your initial reaction in terms of how this budget plays out for both the real estate as also the startup ecosystem.
Yes. As Mr. Savlani mentioned, we were all expecting that ATIB would be extended. Nothing was mentioned in the last budget, and we were hoping that that was an error of omission. But that is, I think, a major takeaway from this budget, that if you're talking of housing for all, then we needed to have that. The private sector has a role to play. Of course, 48,000 or thereabouts crores have been allocated, but that's through government schemes. For housing, they are talking of 8 million homes to be constructed over the next few years, and they have allocated 48,000 crores. But what about the role of the private sector? And what about the middle and the upper middle classes who also need to be housed? And that's only going to happen to the private sector. So that is a major omission. Secondly, nothing has been mentioned about the subvention scheme. The interest subvention scheme of around 2.67 lakhs, which was a great boost for lower middle and middle income people. So I think that is another glaring omission. And these two incentives really incentivize the private sector, and really did a lot over the last 6-7 years. So I think that was that. On the other hand, we do welcome the uniform land registration, a unique land identification number, and the whole thrust of this budget, as my two fellow previous panels also mentioned, has been on the thrust on digitization, and that's the way to go in the 21st century. So, that, and also the details are missing, but the states have been urged to reform their building codes and to encourage housing along transit-oriented zones. So Gujarat has already done it, but I guess I hope that more can be done, especially on the building codes. The other one is regarding investments in startups. Also sustainability. They are talking of sustainable cities, which is also always good for real estate, because that's going to attract more international living and cosmopolitization of our cities, which is over the long run going to give a fillip. Yeah, I think regarding real estate, that is what I had to say. Regarding startups, you have lots of initiatives being taken in fintech, in edtech, and in health tech. So, and also for robotics, drones, a huge amount has been allocated for drones, especially in their use for agriculture. So, and that, of course, this will all involve the private sector. So that will energize startups working in these sectors. Also in sustainability, battery as a service, and EVs, they are going to be receiving more incentives. So, the government is getting its act together. They have been doing it, putting the enabling infrastructure in place over the last 3, 4, 5 years. There have been gaps, and I think these are being addressed. Also, the tax on angel investing for LTCG, long-term capital gains, that has been reduced. So that could be savings of 2 to 4% for the taxes on angel investors, so that which could be lowered from around 28% to about 23-24%. And also the defense sector, 65% of the R&D budget for defense has been reserved for local entrepreneurs. So that's also good. And a lot of startups are working in the defense sector. We have seen startups working in the field of satellites and stuff like that. So and a lot of defense initiatives. So that's going to give a big boost. Also, not only R&D, but total overall defense expenditure, 65% is going to be procured from local firms. So that may benefit larger firms, but also the larger firms work in collaboration oftentimes with the smaller firms. So that's going to ripple through the ecosystem. And so that's also digitization, the digital currency we have been talking of. A lot of startups thrive, especially in fintech and now in all tech. You are able to pay with a digital rupee. That's going to have unforeseen good consequences, I think, for the startup ecosystem. So one doesn't realize now, one doesn't even envisage what can be done. Still, and I'm sure even if we did all the brainstorming, there is still some innovative idea coming from some corner of India using this as a platform to create an entirely new industry. So I think that's a major thrust, and that's, I would put it as part of fintech and social and fintech and also financial inclusion. So, so that, and also it will reduce the cost. Paper costs money. It's also not sustainable. So if we are looking at sustainability, we are looking at that. And also if you're looking at sustainability from the point of solar panel production. So there are a lot of startups working in innovative materials for solar panels. And I think that is going to be a big boost.
Thank you,
I think that's about it.
Yeah. I think we will have some follow-up question, but let me address Mr. Komal Anand, who represents the FMCG sector and consumption. Whether the budget will drive consumption and what it has in store for the FMCG sector. So your quick take. I'll request the panelists to be brief with their comments. Thank you. Yeah.
Thank you, Umeshji, and yes, I will be brief with my response. I think this budget to me is clearly walking the talk. I think there is a clearly articulated roadmap that has been defined for the country, and it's consistent. So whatever we're seeing in this budget talks to the direction that the leaders of this country want us to head into. Combined with your point about consumption, so I think clear indicators that the 35% increase in the capital investment outlay by the government, so that's a very big commitment. That is bound to create opportunities across the system, which will generate demand. When there is money, when there are jobs in the economy, it will create a positive impact and drive consumption. I think the hospitality industry since 2020, the first COVID wave, has been languishing, and that's hit the FMCG industry in of various, different companies have different stakes in the hospitality industry. So it's hit us hard. Apart from hitting the operators, it's hit the FMCG as well. So it's good to see that the government is, has a very strong, clear plan on the hospitality industry. And I think, apart from the financial outlay in terms of capital infusion, focus on MSME, hospitality industry, I think the long-term commitment that India has made towards a clean, green environment and the entire action plan around that, I think is a very positive indicator for the world. So, I think one of the things that any company that invests in India is, what's my long-term roadmap? So, look, I'm a very positive, I'm very optimistic about the consumption potential that exists in India, whether it's, bits and ups and downs in the economy because of COVID, but the long-term agenda of India and the consumption opportunity is so massive that I think it will continue to be an attractive destination for investments for any global company. And so much, so for Lotte Korea, I think India is seen as one of strategic investment destinations. So clearly, the only worry that I have is inflation, and I think the professor did talk about it. Not all of it is something which may be under our control. The entire impact that the conflict, Ukraine, Russia, is bound to have a cascading effect on the Indian economy as well. So if the RBI can manage to control inflation, then consumption is not a problem. So I think that's my take on how I see this impacting. Clearly, it's going to have a positive impact on the economy and FMCG.
Thank you, Mr. Anand, and Mr. Nupresh Shah from Symphony represents the white goods, consumer durables. Sir, your take on what this budget does for the sector generally.
Thank you. Let me start on a lighter note. जैसे हर बजट में होता है, इसी बजट में भी अमीर को मिला थोड़ा बहुत रिबेट, गरीब को मिली सब्सिडी, बाकी सब टीवी देखो, उनको मिला डिबेट. Having said that, of course, there is nothing in particular or specific about consumer durable sector, but considering some of the specific announcements, certainly it's going to be very, very helpful. Having said that, irrespective of the budget, I would like to share that consumer durable sector is going to see phenomenal growth in the short term to medium term to long term growth. As it is well known, the penetration of several consumer durables is so low. Forget about the developed countries, even vis-a-vis developing countries. Secondly, over a period of time, in fact, there is a gradual move from unorganized sector to organized sector. Thirdly, One because of pandemic and otherwise, not only in urban, but even in semi-urban and rural area, there is greater and greater aspirational demand. And that's what also driving premium and other consumer durable goods. Having said that, of late, especially in last 15 months, there has been a massive increase in the input costs as well as logistic costs, which has badly impacted several consumer durable companies. But it seems that now it has mellowed down. Having said that, as everybody knows, in fact, current year and last year budget were presented in highly challenging environment. And hence it was a fine, delicate balance between the deficit, inflation, and growth. So having said that, despite massive allocation of $529 billion of infrastructure has been given, and we are really going to see in the time to come latest world-class infrastructure. And we have to compare this vis-a-vis what now even US is talking about, spending $2 trillion on infrastructure in 5 years. So we are at that level. Thank you.
Thank you. Thank you, Mr. Shah. Over to ma'am. A lot of the budget hinges on the overall GDP forecast. India is one of the fastest growing economies over the next 2-3 years. But do you, ma'am, believe that whatever the budget estimates in terms of GDP growth, whether those will be achieved, and what's your take on the GDP growth forecast? Again, I'll request all the panelists to be brief and pointed with their replies so that we can cover as many issues as possible.
I think the economy did well to revive post the pandemic. We know what was in store for us in the month of April and May of 2020. So having gone through that, which takes you down to the rock bottom of zero, you moved up. So whether you look at NSO data, whether you look at the RBI bulletin, whether you look at the World Bank bulletin or IMF, I think the optimism about India's growth is definitely there. And there is this aspirational India that is there that needs to be looked at. But what we need to do is, a lot of people had moved below the poverty line because of the pandemic. Now you need to push that up so that different sectors will get their impetus. So the consumption, which is a driver of the economy, moves up. So you have consumption, you have investment, you have export, and you have government expenditure. If you look at this budget, okay, government expenditure is coming in. There are two things which we find a little weak up till now, which has started improving. That is private consumption and private investment. But as I say, investment is there if we want to raise it. The world is at $94 trillion. It has a 26% gross savings rate. So there is $26 trillion that is available globally, and India is an attractive destination. So I don't think money is an issue. Again, my point here is the absorption of that money is the issue. The third is we have a very high foreign exchange reserves, almost the fourth largest country in the world with the foreign exchange reserves. And even our Honorable Minister Gadkari ji has talked about how it can be used, a policy can be used to look at enhancing that. So investments, if required, are there, but I think the operationalization of the thoughts into action and implementation is where we are always lacking. So there has never been a policy deficit. There has always been an implementation deficit in that sense. I do feel that this budget has not talked about reducing inequalities. So from my point of view, it may not be appreciated on this forum, but I do feel that if an inheritance tax or a wealth tax would have been talked about, at least it would have looked at an additional amount that we are looking at the people at the bottom of the pyramid. It would have been signaling, but maybe the signaling would not have been effective. So I leave that to future times, maybe post 2024 elections. But the aspect is that, do we want just macroeconomic stability, or do you want, we have about 330 million households, out of which how many households pay taxes? and out of which how many households actually have all the bare necessities, like, drainage is a big issue. There are villages where almost millions of people stay, because there are almost more than 1 lakh of villages which have a population of 10,000 plus. And therefore you need infrastructure in those villages which are urban-like. And that's going to be something that can push. So if you remember the 2000 budget that was talked about, the Prime Minister's Gram Sadak Yojana and the National NH4 that had come in, I mean, all the National Highway program, Bharat Sagar Mala, etc. I think those were big pushes. So that kind of a push, if it had come, it would have been good, because it would have signaled a number of sectors for improvement and would have generated its employment. The sectoral push had to come in.
Thank you, ma'am. Mr. Ghatak, my question to you is, COVID pandemic, especially for the pharma sector, the entire pharma sector went a lot of supply chain disruptions. You now have a PLI scheme, and very attractive PLI scheme for the pharma sector. So how do you see both of these impacting the growth potential of the pharma sector, especially when the world looks to India as the pharmacy of the world?
So thank you. Before going to that question, let me actually give a little bit of analytics which can help you understand that where we stand in terms of the pharmaceutical industry. We almost everybody knows that, we are the world's third largest in terms of volume, and, in terms of value, we are 13th largest, and so on. But if I talk a little bit more micro economically, the pharmaceutical industry, or the drug industry, almost contributes 43% of the total out-of-pocket expenditure on health in India, which also means that, around 63% of the total health spending of the country goes for out-of-pocket expenditures, which is basically one of the key driving factors for the development of production link incentive scheme in India. Because we have seen for the past several years that India's reliance on the import of key starting materials, or APIs, what we talk about, are highly dependent on imports from our neighboring countries. And if I address, why it is so, it is basically the import dependency is basically largely attributed to lack of cost-effective options in domestic API manufacturing as compared to imports. So the PLI scheme, which we have now, which is almost like 10,000 crores to boost the domestic production link and the domestic manufacturing for some key critical start materials, of course, comes with a self-resilience for the Indian manufacturing industry, including pharma. But, I think, as I said before, probably, in addition to specific incentives towards R&D and reviewing the compliance burden for ease of doing business, it would have been nice if, if the government would have actually reviewed the PLI scheme for pharmaceuticals as well, because additional budget allocation and expanding the scheme specifically to brownfield projects maybe for pharmaceutical sector would have encouraged investments, it would have promoted employment, it would have attracted more knowledge competency and make in India feeling in global markets. So I think we go hand in hand in terms of discussing these aspects, which we are already taking up with the relevant ministries, but identifying the production link incentive scheme for exports to the other market. We are already a leader in generics. I mean, there is no question about that. We do have specific, expertise in therapeutics areas with specific medicines as well. But schemes like these, which is actually, when you term drug security is related to defense security now for the last 2 years, it's very critical that we identify it and nurture it so that the dependence of around 70 to 80% of materials to be imported to the country for making these drugs can be made in a more indigenized way rather than reducing that or depending on that particular case. So probably a little bit of more work is needed on that part, which the industry will obviously work towards with the ministries. And I'm very hopeful that there is already an open window and open door for discussion happening, and it will be taken up favorably.
Okay, thank you, Mr. Ghatak. My question to Mr. Savlani is that we have been hearing Make in India. We have been, COVID has shifted some manufacturing attention from China back to India. Government seems to be working on this $5 trillion scheme. Manufacturing accounts for 20% of the GDP. How do you see the push in the budget to help India grow to a $5 trillion economy?
I think the government has taken the step toward that direction. Of course, these are the all long-term steps. So ultimately, the result will come with some lag effect only. But definitely, the steps has been taken by the government. I can tell you about my industry, 60,000 crore being allocated to Jal Se Nal scheme, which is completely going to be beneficial to the manufacturing industry only. Similarly, 48,000 crore being allocated to the Pradhan Mantri Awas Yojana, directly or indirectly related to the construction. So most of the products will come into that sector also. And beside that, if you see that they have given this time the thrust to the defense side. So 65% of the defense procurement will be a domestic, so which will be again a manufacturing thrust. Because I was seeing the number of allocation to the defense side, it was 5,25,000 lakhs crore rupees, the huge number. If 65% of that is going to be for the domestic, definitely manufacturing is going to get a huge benefit out of that. Another thing which I earlier also said that you see for any manufacturing sector to grow, the capex requirement from the government side is also equally going to contribute. And in this budget, the thrust being given to the capex. So 7.5 lakh crore rupees being allocated for the capex. And if you add the state side, then total 10.68 lakh crore, which is a huge number, which is definitely going to support to the manufacturing sector. First time I am seeing that the allocation to subsidy being reduced drastically. So like earlier this figure was the previous budget, it was 7.07 lakhs crore on the subsidy, which actually this year revised estimate is 4.33. So almost 39% drop in subsidy. And this year, next year budget, they have given it to 3.17 lakh, again 27% reduction into the subsidy. So now you can see that the utilization of fiscal deficit is going toward this productive use rather than non-productive use. So far, we were spending our most of the fiscal deficit on the non-productive side. Now, first time we are seeing that we are going to use this for the productive use, and that is why we can say that the manufacturing sector is going to be a big beneficiary out of that. Again, it depends how the implementation is going to take place, because number always look rosy, but when the part of the implementation come, it create a lot of doubts in the mind. So if right away this amount, whatever they are speaking in the budget, if they will rightly allocate and the implementation will be on the right direction, I'm sure it is going to help to the industry. And a lot of announcement being given to the road sector also, 20,000 kilometers. That is also going to help to the cement industry, many such manufacturing part of the industry. Similarly, lot of, I can say, supportive system allocation being given. Maybe you can say Gati Shakti project or multimodal movement of goods, even this logistic part, railway support system, many such announcement being there on the freight corridor side and all the things. So all this, I think, directly or indirectly is going to support to the manufacturing industry. So I think 1 trillion mark looks a wish list, but I think definitely a step being taken toward that direction. So hopefully we will reach to that mark, maybe a little bit here and there, it is fine. But at least the government has sincerely taken efforts to that direction. So ultimately we will reach to that mark figure.
Thank you, Mr. Bakeri. Your quick take in terms of misses for the startup sector, anything that you felt government could have done better than what it has done?
I think that if a startup is a risky investment, as we all know, investing in startups. So if that could have been merged, any losses that you incurred in a non-listed companies, if those could have been put in the same bucket as your other gains, whether they be your business gains or LTCG or STCG, that could have been really shot in the arm for the startup industry. That could have incentivized more people to go out of their comfort zone and invest.
Okay. Mr. Anand, my question to you is, do you see this budget ushering more consolidation, more mergers, more acquisitions, more foreign investment in the FMCG sector?
No, I think it's going to be business as usual for FMCG companies. I think companies typically a company doesn't look at a budget announcement to decide investments or not to invest in a country. So it could be a Britannia, it could be a Mondelez, it could be a Unilever, and it's have more. I think we are pretty clear about our 5-year strategy roadmap, and the budget talks to it. So there is nothing adverse that would make us rethink. That's one. Mergers and acquisitions are a part of the game, and again, it depends if a company believes that it's reached a certain stage where its organic growth has plateaued and needs an acquisition, that would continue. But if you look at the startup space, I honestly do not see any change in the momentum that the economy has witnessed in the past 10 to 12 months with respect to mergers, acquisitions, startups. I think the momentum is going to continue. So,
okay, thank you. I think a lot of the speakers, I think the common thread that we are hearing from the speakers is that this is a long-term visionary, and therefore the government is trying to do all that it can do rather than giving bits and pieces here and there, and therefore most of the panel members seem enthused by what the budget is going to do. So Mr. Shah, my question to you is generally in terms of the manufacturing ecosystem, where there are a lot of parameters in terms of labor code, in terms of other micro aspects on the manufacturing sector. Do you see anything specific in terms of misses on the manufacturing sector?
So I won't like to say anything missing, because that is always going to be a long wish list, and that can never be met with. So considering the reality, I think most of the overseas investors are clearly adopting China +1 policy, and hence India is really going to witness really booming time, as long as simplification, as long as ease of doing the business, infrastructure boost, etc. continue. Secondly, despite current year massive growth in excess of 9%, and next year also estimated growth in excess of 9%, I don't think we should be over jubilant. The reason being, by end of current year, in terms of our overall GDP, in fact, we will be still at par with where we were at the level of pre-COVID. Secondly, in terms of the overall manufacturing output, despite current year massive growth, as on March 22, absolute amount wise in real term, we are going to be lower than pre-COVID. So, statistics many a times can be misleading. Thirdly, even though we may be 9% plus growing and on $3 trillion size, it means annual addition of roughly $250 to $300 billion. And despite China is slowing, and even if it achieves just 5% growth, its size is 16 trillion. And on 16 trillion, adding 5% is annually $800 billion. So even in absolute amount, it's more than 3 times. And country like US, despite hyperinflation, on an economy size of $22 trillion, just growing by 3 to 4%, it's annual addition of 700, $800 billion. So I think certainly we as a country, we as a manufacturing sector have a lot to do, catch up in that respect. But I think certainly it's happening. Unfortunate side is, especially because of COVID and otherwise, many marginal MSMEs are really losing the fire. And hence, economy is really a lopsided. But that is the reality. So that is part one. And part two related to capital market. Fortunately, there is a booming time and likely to continue that way. And we have to also, in fact, accept that in a country like us, wealth creation cannot be destroyed and government is not really going against it. A small measure in this budget proposal, that surcharge won't be in excess of 15% on long-term capital gain tax in excess of 2 crore. In absolute amount wise, it is negligible. But government is also encouraging wealth creation, and despite leading to some income inequality, wealth inequality, it's good for the economy.
Thank you, Mr. Shah. I think you touched upon capital markets, and I think so far we've not had any take on what the budget does to the capital market. Markets were up, Sensex up 850. We've had some run up before the budget, some correction a few days back. But I leave the floor open to the panelists if anyone would want to give their view or their take in terms of what this budget does to the capital market, because a lot of the participants here are keen to understand the ramification of the budget on the capital market. So, Mr. Savlani, your take.
I think this budget is not going to affect the capital market in a big way. There is no specific announcement relating to the capital market. But overall, I think as Mr. Rupesh ji suggested, that the capital market is going to be bullish in this country only, because we have to understand that there is a change happening in this country first time after so many years, that a young generation is parking their saving into the equity class, which was missing earlier. So now the participation in the equity side is continuously going to grow over a period of time. I can tell you, my boy had just started a job and he has done a 3-4 SIPs, which is unbelievable. I did my first SIP at the age of 35 years. So that is the big change I am seeing on the ground, that young generation is understanding the importance of equity, participation of the equity. And secondly, I think a good platform being provided to the startup community, I think, which was missing at all in our country. And now the best part is that we are seeing now even the TV channels are promoting these kind of initiative like Shark Tank, and that kind of programs are being promoted on the TV channel. That is even giving the more boost to the young generation and the startup community. So I think all these things are suggesting that the sooner or later, the allocation of equity, which is very low in our country compared to the developed part of the globe, if that is going to support it, I don't think equity is going to have a setback in this country. So equity is going to definitely perform. In spite of so much of withdrawal from the FII in last 5-6 months, I think more than 120 lakh crores of rupees amount being withdrawn by the FII, still our market is hardly down 5-7% from its peak, which is nothing. So overall, I think I'm very bullish about the equity side of the economy. And the capital market is going to definitely reward to the investor, particularly who are the long-term. Short-term, there may be some setback, may not be internally related to our country, but maybe from external shock can come. Like I was listening some of the, I think, equity guy on the channel today, that the biggest painkiller to our economy will be the crude, because budget estimate so far is being done on the consideration that the barrel price will be $75, while today existing price is 90, and there are high probability and there are projections that it will cross $110 to $120 also. Now, if hypothetically it lasts for a little longer period for this kind of price, then definitely it is going to affect our country, because we are sizably dependent on the imported oil. and which is going to be a joker for the growth story of the India. So if that is going to affect, I think we are going to see a big setback for our economy. Secondly, raw material side inflation is huge. Today, whatever the collection number we are seeing for GST and all this thing, major contributor is the price rise. I can say inflationary things. That is why these numbers are coming very high. If that is not going to come down in the near term, then also it will be a big setback for the growth. Then fast inflation will come and we will see sizable increase in the interest rate. And that is going to be a detrimental to the industry also. So few worrying factors are also there to the equity market. But overall, I think the trend for the long term for the capital market is very, very, very robust in our country.
Thank you. Thank you. We are running out of time, but we have a few minutes. And if there are some questions from any of the participants to any of the panel members, I leave the floor open for just a few questions.
Yes, I will take questions one by one. We have few questions. So there is one question from
Ma'am, we can't hear you.
Hello, am I audible now?
There is an echo. There is an echo.
Am I audible?
Ma'am, there is an echo. Maybe there are some other laptops or connected devices. If you can put them on mute.
I think now it is clear. Now there is no echo.
Yeah, you can ask your question.
Okay, this question is from Deepak Singh. He says that FM proposes plan for swift movement of goods.
Type your question, na? Type the question.
Meanwhile, if there is any other participant who wish to ask the question in the interest of time.
Maybe meanwhile I can read the.
Yeah, so the question is, FM proposes plan for swift movement of goods, that is all logistic companies brought on unified logistic interface platform. What is this unified logistic interface? How does it work? How will it benefit the logistic industry? That is the first question.
Jyoti madam.
I can take it, yeah. See, the moment you have your logistics, which are, multimodal transport, as they talk about, it will lead to trade facilitation. There are two aspects, the internal trade as well as the external trade. And the amount of time it takes for, we are a country of, large population, large, north, south, east, west movement, as well as our trade with the rest of the world. I think where we go wrong is with our cost of logistics. And once this comes in, I think the real time flowing in and seeing things, also there would be options for you to decide which is a cheaper mode of transport. So trade, I think this is really to take you to trade facilitation. And the best way is to build the core of the economy, that is with strong infrastructure. And this is what will come out with both exports. If you've seen the last 10 months, have seen exports touch beyond 30 billion every month. So maybe now you would see it going to $400 billion by the end of this financial year. So looking at this, I think it would bring in a lot of linkages, information, transparency in the manner in which your goods are moving.
Thank you. Thank you, ma'am. Pratik, one last question from you to any of the panel members.
Yeah, just a second.
Sorry, I will have to leave because I need to join somewhere else.
Yeah, thank you, Mr. Shah. Yeah, Pratik.
Yeah. So the question by participant is that if they have a loss from virtual digital asset in 1 year, can they carry it forward in another year? And another question in this regard is also that while calculating the capital gain, whether indexation benefit would be available or not.
Yeah, so as far as virtual digital assets are concerned, the existing provisions don't permit any carry forward of losses. And I believe since there is a special regime for taxation of virtual digital assets, indexation may not be available, but we'll have to look at the fine print to clarify this.
Okay.
Madam, any comments from CII? Mr. Agarwal?
Should we, so should we close the questions, because there was few other questions, but maybe we can take it up offline and I can share it and it could be answered, because we had 2-3 more questions remaining, but seeking the time constraint, as you suggest, can we take up 1 or 2 more questions, or how we should go about?
Maybe we can extend it for 5 minutes, and if there are any questions.
Sure. I'll just read out one question that what kind of data forms must be introduced to simplify the process of taxation and returns filing impacting the larger population of the taxpayers? Maybe any of the panelists would like to take up this.
Let me respond to say that government seems to be working on collecting data, macro data. A lot of this is getting populated in the 26 AS, and therefore we are likely to move to a era where bulk of the data would get populated, which will help the SSCs generate their tax returns. So this is the direction where the government seems to be taking, especially for individuals, salaried persons, salaried SSCs.
Thank you for answering this question. We can take up this last question and then we can have the conclusion.
Can I come in here? I think there's one question in the chat box which says that, has posed to me that is the budget protectionist and inflationary? And I'd like to give my views on this. Inflationary, you always, is it protectionist? The moment you say it's Atmanirbhar Bharat, then you are obviously putting up your customs duties, and most definitely that adds to the cost. So free trade has always been what the WTO and what we have been signatories to have said. So in fact, imports is always based on the principles of comparative cost advantage. So the very fact that you push in for your own manufacturing, you are defeating the cost of, you're defeating the principles and theories of comparative cost advantage. And you're looking at something which is generating employment out here. It's neither doing that. So you're losing it on 2 fronts. One is on the cost front, and 2 is on the lack of generation of employment. And 3rd is we've always believed in global value chains. We need to create those global value chains. So definitely this would be inflationary, and I think it's a very good question. Thank you.
Thank you, ma'am. We have this question. I will just take up last question. Whether indexation benefit is available while calculating of acquisition cost of virtual digital assets in case of long-term holding.
I think I have already clarified that.
Sure. Fine. Then in that case, we would go ahead and on behalf of Mr. Vinod Agarwal, Chairman CII, actually had to leave for some urgent meeting. I would like to take up this opportunity to thank all the esteemed speakers and the panelists for sharing the valuable inputs and insights about the post-budget analysis today, and also for sparing your valuable time and to be a part of this discussion and session. I would also like to thank all the participants who have been patiently listening, and we hope we were able to address few of the concerns and queries and take up the insights and information about the post-budget analysis. any further, we would like to take up over the mail and you can reach out to us. Also, my earnest thanks to Dhruva Advisors LLP to partner for this session today. And thank you once again for this wonderful session. Thank you once and all.
Yeah, I also take the opportunity on behalf of Dhruva Advisors to thank CII and each of the panelists for a very interesting round of discussion. I'm sure in the next few days we'll have more micro analysis on the budget, but I think the thoughts that we got from each of the panelists would definitely help us to digest the budget in an appropriate manner. So thank you, and we look forward to more such opportunities for interacting with all of you.
Thank you. Thank you.
Thank you.
Yeah.
Thank you once again to all. Thank you.
Thank you.
Thank you. Bye.